Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've started following his work on Twitter, on financial Twitter, for the last couple of months. He puts out some amazing global macro charts. He also has been blogging over at Substack for a while. Now, because of compliance at the bank he works for, he's not allowed to give his name. He tweets and blogs with his in-depth global macro financial articles under the name Deer Point Macro. So thank you for joining me today.
Not a problem, Jason. Thank you for having me.
Yeah, and I thought we'd disclose it early on that because of compliance issues, you're not allowed to use your name. So for our listeners out there wondering, that's why. So it's like, obviously we would love transparency, but everyone wants to keep their job.
Yeah, I would like to maintain my job, especially now. A lot of uncertainty in the world.
Yes, lots of crazy stuff going on. And we're recording this interview on Monday night, June 5th, 2023. The dollar index is above 104. So it's starting to put a lot of pressure on all that global dollar denominated debt. I want to get your thoughts, though, on the narrative that's going around. And it seems like every year or two, Dear Point, there's a new narrative that whether it's petro yuan or a new trading block or some type of crypto gold-backed BRICS currency, you name it, it seems like every year or two, there's a new narrative on de-dollarization. So in your opinion, and I know you just put out a new in-depth article on this in the last couple of weeks, is de-dollarization for the global economy feasible in the next couple of years? Why or why not?
Yeah, I guess in the I'll try to keep it short and sweet here. I don't believe that, de-dollarization is anywhere near to becoming a reality. There's a couple of things that I kind of have been monitoring. One is, where are we from an FX reserve standpoint? Right now, for example, the renminbi only accounts for it's about 2.7% of overall global FX reserves held by central banks. Albeit, the rate of growth has been very rapid, but this was coming off a almost non-existent base. So when you're looking at the rate of change, when it's coming off a very low base compared to something like the dollar or something like the euro, obviously that rate of change is going to be very extreme. So when people see that, it kind of a lot of people kind of buy into the narrative. But that's one thing that people have to kind of keep in mind. But again, if we look at the overall global financial system, mostly of which, I kind of look at this euro dollar and offshore banking system, that whole name of the game is still heavily involved in kind of dollar, the dollar will remain king. Something that I kind of wanted to point out is if you actually look at capital outflows right now from China, capital outflows are negative, albeit they have started to ease as China started to reopen the economy. The interesting thing about that, though, is that if you look at capital outflows, it's not flowing through to FX reserves, which is kind of odd, right? Because you would think that, if you were seeing these capital outflows, that would have to start to show up on their FX reserves. But what we're really seeing is that those capital outflows are taking place in the kind of the offshore dollar market, right? Or the offshore yuan market, and outflows in the yuan are getting converted into these offshore dollars. And obviously, that's something that's absolutely massive. Goldman Sachs actually estimated that, between 56 and 87% of outflows took place through offshore markets. In terms of people converting those over into dollars from yuan. So, I mean, if we look at something like that and we're seeing that rate of change, be extremely drastic, actually, if you look at the year-over-year numbers in turnover volumes in China in terms of turnover for people converting yuan to dollars through swaps, that has actually continued to increase pretty much over the last 5 years or so, with the most recent figure being up 56% on a year-over-year basis. So, with that being said, I don't really see.
Could you quickly explain? So not all of our listeners are involved in the financial system or work at a bank or a financial professional for 15 years like me. Could you just explain quickly what FX swaps are or forwards are for listeners out there?
Yeah, so the swaps that I'm talking about, there's two kinds of swaps. So the ones that we're actually talking about are swaps that are non-deliverable swaps, and those are typically traded offshore, so outside of China, and all of those cash flows are settled in US dollars. So if you were to look at that, pretty much the most basic way to think about it is just people essentially converting if you're Goldman Sachs, you're lending dollars to a Chinese counterparty, and they're giving you yuan plus the cash flow. I'm trying to keep it very simplistic here. And then at the end of the tenor, those things are swapped back. That's probably the easiest way to kind of think about it. We're not talking regular FX swaps in the sense of FX forwards. Most of these are through things like, cross currency basis swaps, et cetera, which are slightly more complex than FX swaps because they're fixed and floating. So this is kind of in the most simplistic terms what you're really seeing kind of take place in the offshore market. So it's the Chinese company is giving yuan plus the Shibor, which is their version of the SOFR rate, and then the U.S. company, whatever the spread between the SOFR and the Shibor is the basis, and that's the premium that Chinese borrower has to pay to swap yuan for dollars. Is that pretty simplistic?
So if I were to simplify further, you're saying that despite the narratives here that a lot of these countries are saying in the BRICS and others that they want to abandon the dollar, they're investing in another system. And there's been different narratives about different types of de-dollarization for the last 15 years. I've been covering this for almost 15 years now, all the different types, and arguing that it's not going to be so simple to switch out of that. You're saying that the demand for dollars inside China, in the Chinese economy, whether it's Chinese banks or Chinese companies, Chinese real estate developers, the demand for dollars is actually still pretty strong.
It's still very, 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 very strong. Because I mean, if you think about overall kind of, global financial markets, um, you know, everybody relies on dollars for funding to some extent, whether you're talking, debt denominated in dollars, or if you're just talking, outright need for dollars to fund long-term portfolios. You see things like that in the European banking system. So all of this interconnection of the dollar is extremely important to the functioning of global capital markets. So I don't see any of that going away anytime in the near future.
Well, the dollar is also relatively more stable and stronger now than the Chinese yuan, because lately the Chinese yuan has been slipping. I think it's around 7.3 Chinese yuan to the dollar right now. So I mean that's it's starting to be devalued relative to the dollar. But you're seeing all these crazy things inside the Chinese economy. So I mean the narrative out there is that China's economy is healthier than the US because people see the national debt, but there's a lot of problems inside the Chinese economy, inside the Chinese banking system. They have a housing bubble bursting. They have local government finance vehicles with tons of bad debt hidden off balance sheets. And then on top of this, to your point, there's many trillions. I've seen estimates of tens of trillions. I mean, Kyle Bass has said there's tens of trillions of dollar-denominated debt that the inside the Chinese banking system and their shadow banking system that they can't pay back.
Yeah, and I mean I think that's a very real risk that the Chinese are running, and that kind of actually could bring us into our next topic, which there's people who focus on China because if you are, let's say, running an ETF or a global fund, those guys are allocated anywhere between 30 to 40% to China, right? So there's always going to be this inflow from foreign investors just to equity markets as of now, just because you essentially have to allocate there. But if we actually start to look at debt markets, China has seen an entire year of outflows of Chinese, foreigners essentially fleeing from holding Chinese debt. So, you have never actually seen that last this long. Usually you might see 1 month of outflows. But essentially since the beginning of March 2020, or actually pretty much the end of December of 2021, investors have continued to kind of flee China. And I think a lot of that is kind of over mounting fears that China is not going to be able to repay all of its debt, whether it be dollar denominated or debt that it has actually issued domestically. And so, that's another problem, is if you believe that these nations are going to become a reserve currency, you would assume that people would want to hold their debt, right? Because, they would see it as relatively risk-free, and they would see it as kind of a good place to get yield. But no, you're not seeing that at all. You're continuing to see people, whether they be from emerging markets or more developed markets, actually selling Chinese debt and running for the hills currently. So I believe right now, in terms of billions, it was I think it was roughly like maybe a little bit less than $1 billion of outflows coming the end of March. I think it was 850 million or so off the top of my head. But nevertheless, just how long those outflows have been continuing, I think is very worrisome. If you're China.
And the non-G7 central banks, the countries that are running trade surpluses, so they have the option with higher interest rates now. They could either buy U.S. Treasuries, they could buy Chinese debt, so there's yield there if they want to recycle reserves into those things. Instead, what the non-G7 central banks are doing largely, they're not trusting any government. They're buying more physical gold tonnage. So that seems to be a diversifying measure for reserve assets. So most of these non-G7 central banks, as a reserve asset, they're not going to go buy Bitcoin. I mean, I guess Guatemala is. But the majority of non-G7 central banks, like their options are either government debt, like you said. So either they can go buy Chinese government debt, or they can buy U.S. government debt, or they can go buy gold tonnage.
Yeah, exactly. And I mean, so you really have two options. You have U.S. debt, or if you're Europe, your own domestic debt. But then, Europe has that weird fiscal situation where they all have their own fiscal entities. So even, not all European debt is the same. But, in that sense, you really only have two choices. You have treasuries and you have gold. So I think that a lot of these banks are making the gold decision because obviously, if you had bought for people, very basic, but for people to kind of understand how a bond works, obviously, the interest rate and the price of the bond are inversely correlated, right? So if the interest rate goes up, the price of the bond goes down and vice versa. So, if you had bought any of this debt, over the last 3 or 4 years, you're absolutely bleeding. And, gold is really the only thing that can actually protect, I think, a lot of these central banks from a portfolio standpoint, so that they're not pulling provisions to cover losses that they're taking on, other whether it be dollar denominated debt or other kind of cyclical assets.
Yeah, I agree. And there's actually a lot of bond losses that have not been marked down yet, mark to market losses yet, because these bond fund managers, either at a bank, a hedge fund, a pension fund, an insurance company, private equity, whoever was doing these leveraged bond trades or had a large bond portfolio, they haven't marked down the losses yet. So and this is what happens as the Fed goes into a rate hiking cycle, these older bonds, like you said, the value of the bond just keeps falling. So there's a lot of losses on bonds that are going to be coming due, especially in the U.S. banking system in the not too distant future, unless, of course, the FASB and the Federal Reserve Bank and the U.S. government, the U.S. Treasury approves it, decides that they want to allow accounting rules changes, no mark-to-market accounting for any of the banks.
Banks, yeah, exactly. And, that really changes the whole precedence, but I'm not sure if they're willing to do that at this point. Right. So.
Well, I think the banks at some point, a lot of the banks here in the U.S. are going to have to do equity capital raises. So we'll see what happens. I mean, if I'm a new investor and I want to, and I'm potentially looking at a deal to buy equity capital in a bank, and I'm managing a lot of capital, like institutional level, you're going to want to see mark-to-market losses first before you give new equity capital investments into a bank. So you're going to want to see mark-to-market losses on the bonds, the commercial real estate loan portfolio, all these losses first.
Yeah, exactly. And I think that that's actually something that's very interesting if we kind of look at what's happening in the US banking system, is because you have all of this money, whether, you look at guys like Buffett, et cetera, who would kind of be, the first call from a lot of these banks, they're all in a bit of a standoff, right? Like they don't want to move. And on the opposite end of that, you have the Federal Reserve that seems pretty complacent. So, either you get a capital raise or you cut interest rates dramatically again, and I'm not even sure that that would be enough to kind of try to offset the mismatch that they have from a duration standpoint. But again, that can lead to a whole another kind of bunch of issues within the financial sector. And I don't even know if cutting interest rates at this point would really do anything. I think that it's more capital raise, but all of these guys are essentially sitting waiting for something to change before they, I think, make a move. And, I think that there's going to be a lot more bank pain before we start to see something like that.
Yeah, I agree. Christopher Whalen, we were discussing his articles before we started recording. I mean, he's considered a very conservative bank stock analyst on Wall Street, and he's been writing blog articles and reports and doing public interviews on Bloomberg News, business television, saying how the banking system is already insolvent. There's FDIC reports out warning about that the banking system is insolvent. The banks are tapping over $1 trillion of a secret liquidity facility from the FHLB, so they're not going to the Fed's discount window. There's just a lot of red flags there, and then they haven't even marked down the losses yet for commercial real estate. I mean, that's really just, I would say that's the first inning of this crisis. We're just in the first inning for the commercial real estate problems here in the U.S.
Problems, yeah. Yeah, I would agree with that. And then you have banks, I won't mention the bank, but you have, one bank that's in Arkansas that has a lot of commercial real estate exposure. I think that this is actually a very interesting point is, Mike Green actually raised this, and I broadly agree with him. To some extent, the banks can be partially to blame, right? But on the other hand of that, a lot of this is also the fault of the Federal Reserve, because if you go back over the last 14 years, like what could banks have owned that would have allowed them to pay 4 or 5% on deposits, right? As well to kind of backstop the deposit outflow issue, right? Where you're seeing this flight of deposits into money market funds. The problem is the only thing that they could have really owned over the last 14 years that would have allowed them to pay 4% on deposits would have been high yield. And then, you have all the credit risk associated with that, right? So, the banks more or less to some extent themselves have been handcuffed in what they could kind of own in terms of where they're positioning their portfolios. And again, even if you were to look at some of these banks, they weren't making reckless decisions. Like again, if we were to say, yeah, they were owning high yield, you could understand kind of credit problems, et cetera, or counterparty problems. But the thing is, they were owning Johnson and Johnson, they were owning investment grade paper, things that are relatively again seen as risk free. The problem is just the rate of change in interest rates.
Well, the Fed also kept interest rates artificially low for so long. So it was like a Pavlovian response. So they trained all the people in the banking system, the large corporate companies, to keep issuing more and more debt, do share buybacks. So they kept rates artificially low and created an artificial boom. And now with the rate hikes, that's creating the bust.
Yeah. I mean, that's something that has happened, and I think that a lot of these banks are now really feeling the pinch. And I mean, it's unfortunate, right? But again, I mean, what could you have really have done? I mean, sure, you could have said that they could hedge better, but again,
can they hedge everything? Can they hedge everything though? See, I was listening to bank experts talk about that they can't hedge the entire loan book, so they wouldn't have any profits at all. So everyone's like, "Oh, they should have hedged better." Well, they could have hedged some of it, but if they hedged all of it, then they wouldn't have any profits either.
Yeah, exactly. And hedging, especially interest rates, like interest rate swaps, they're bilateral, right? So, I mean, what I mean by that is they start to move very rapidly in one direction or the other. So, if you were having on massive interest rate hedges for the last 14 years, you probably would have sunk yourself just in the movements of those interest rate swaps alone. It's more now.
Well, look at the last interest rate hiking cycle in 2017 and 2018. By mid 2019, we had the repo crisis. So every rate hiking cycle post 2008 just causes a blow up because of leverage in the financial system. And then people are trained, they're buying asset prices on leverage. They're doing share buybacks. The large corporations are doing share buybacks with debt. So they're over leveraged. There's just too much debt and credit and leverage in the system. And then when interest rates rise, when the Fed raises interest rates, especially too quickly, then it just blows things up very, very rapidly.
Rapidly, yeah, and that's exactly what we've seen, unfortunately. But this is the problem. Again, I think if you are to some extent, I understand where the de-dollarizers are coming from, so to speak. I think that a lot of people are looking at this, globally as well as domestically, saying like, we're kind of tired of being, bound to the U.S. financial system and essentially having to set our global financial policy on the back of the Federal Reserve. Because if you don't do that, for example, if you're easing right now while the Fed's tightening, you're going to see a lot of outflows. People are going to start to flow into places where they can get higher yield, like you're seeing now in the United States, right, where you're continuing to kind of see bids from a foreign direct investment standpoint. That's not happening in a lot of the rest of the world. And I also think that explains where the dollar is. And obviously, you have now new Treasury supply coming online, which, again, is going to shift the supply curve.
Didn't the Fed also, so there's a couple reasons I would say for dollar strength. So the Fed has also raised interest rates faster than other central banks. So the other central banks are actually behind the Fed in terms of raising interest rates. So that would add to dollar strength. The other thing is, and I think people don't understand this, so the people that are in the de-dollarization camp, they look and they say that, okay, so China, Germany, Japan are not buying treasuries. And then they see that what total reserve amounts of dollars in reserves, treasuries, dollars, reserves was 59%. It's down from 70 over the last 10, 12 years, something like that. Yep. So it's down to 59%. So it's not below 50% yet. So the trend is down on that. And a pretty good amount of these countries are either not buying more US treasuries or they're selling some US treasuries like Japan or China. But the other side of this is that every time the dollar gets weak, dear point, the amount of total dollar-denominated debt, so whether that's foreign governments or foreign corporations borrowing in dollars, they play this currency game. So every time the dollar gets weak, the amount of dollar-denominated debt increases. So since 2008-9, the average person doesn't understand this. The amount of dollar-denominated debt from foreign governments and foreign corporations, especially emerging markets inside the Chinese economy, from governments and corporations, it's doubled. We're at the official number, I think, is over 12 trillion, and that's not counting the Eurodollar market of global dollar-denominated debt outstanding outside the United States.
Yeah, and this is something that ends up happening, right? Because again, it now becomes somewhat, if you want to say, cheaper to borrow in the United States as the dollar devalues. And so, I think that this is something that a lot of people seem to neglect is, again, you're always going to see this bid for dollar-denominated debt because, one, it's relatively stable. Two, you don't have to worry about default risk, even though everybody was making a big deal about the debt ceiling. And so, if you're a foreign entity, that is really what you want to be doing, right? And even to some extent, as the differential, if you were to look at like forward hedging costs, as the forward hedging costs start to ease, you're going to have more bids again for US dollar debt. And essentially what that means is, kind of is that differential, let's say, between a euro and a dollar, the differential of the spread. What you're going to then end up seeing is as the euro starts to strengthen, and you don't have this massive hedging cost associated with it. So that means like the differential would be positive. If you're a European investor, that's actually a net benefit for you, because you get the yield from the differential between bond spreads, but then you also get the additional yield from differentials from the hedging cost. So a lot of these kind of entities will then start to again bid dollar-denominated debt, and we also saw something similar happen where the U.S. dollar strengthened massively relative to the euro. And hedging cost was negative 300 basis points. So that means it was 300 basis points on the forward hedging cost for the European investor, which is extremely expensive. And what we then saw is we saw European investors say, well, yeah, the yield between U.S. debt and European debt is massive. But the problem is now, if we're adjusting that yield for our hedging costs, we're negative and it no longer seems attractive. So, that actually kind of led to a demand shift to the left, or a lack of demand for the bid of U.S. debt at one point. Now that albeit is starting to ease somewhat, again, you're starting to see a lot of this foreign appetite, not just Europe. It was just one that I knew off the top of my head, start to come back, and people start to bid U.S. debt again. So the lower the dollar goes, the more attractive it is from a hedging standpoint, and the better it is from a differential standpoint between everyone else's debt and ours, right? I mean, we have very attractive yields if you're to look at it on a relative basis, and even if you were to look at just the real yield, if you were to take a let's say a 2-year treasury against a 2-year break even, we have some of the highest real yields. That's how they calculate real yields on a fixed income desk. The 2-year versus the break even. We have some of the highest real yields in the world. So again, for a lot of nations, this is still extremely attractive. And if the dollar moves lower, that's just going to be a net benefit for us, because and I'll kind of end it here. When you get a rightward shift or an increase in the demand for debt, what it actually does is it pulls the yield down and increases the price of the bond, right? So that's actually a net beneficiary for investors. Eventually, supply and demand adjust and you reach equilibrium, but kind of in the very early stages, there is kind of a bit of an arbitrage there, so to say, to be had. So for a lot of these foreign entities, that's going to be more attractive if the US dollar starts to weaken here.
Yeah, so the de-dollarization, yes, it may happen in the long term, but definitely not in the short term. It's too complicated system. There's too many incentives, as you laid out, and you talked about all the details and numbers for why it makes sense for a foreign government or foreign corporation to continue to borrow in dollars, especially if the US dollar relative to other currencies or the dollar index gets weaker, then they want to borrow more dollars. And we've just seen this play out since 2008, despite all the different narratives that have come out over the last 10, 15 years about all the different ways that China and the BRICS are going to de-dollarize. The total number of dollar-denominated debt outstanding for foreign corporations and foreign governments has continued to grow. The trend is growth in dollar-denominated debt. So this is what I mean from reality versus the actual narrative. So if these countries, these foreign governments and foreign corporations actually said, okay, we want to abandon the dollars, well, if they wanted to de-dollarize, why would they take out more dollar-denominated debt? It just doesn't make any sense. This is narrative versus reality and numbers.
Yeah, exactly. And one thing, I had a conversation with Tony Nash, who I believe he worked on the Belt and Road Initiative, and he was telling me that the BRI, the Belt and Road Initiative, just for people, the abbreviations, the BRI. He was telling me that is 100% funded in dollars. So China's largest build out.
Sorry to interrupt you. That is really funny because every single YouTube video that I've ever heard an expert talk about that never mentioned that one fact.
Yep. And he's a great source as well. And he was on a podcast talking about this as well. And maybe I'll send it to you offline. I just have to find it. I was on it with him. But he was discussing that when he was working on the BRI, it was 100% dollar funded. And so, this actually brings us into, some work that I've done both on BRICS and China individually. If you're to look at, long dollar countries, um, which is essentially the balance sheet dollar assets exceeding dollar liabilities, um, which is, kind of that net position, which would be, the difference between the assets and the liabilities, is a proxy for net use of FX swaps. So again, simplistic, to borrow in dollars in the case of China and to lend dollars in the case of the U.S. banks. If you look at BRICS as a whole, Brazil, Russia, India, China, and South Africa, they are all net long dollars. The only one that's the exception to that is Brazil. They're actually short dollars. Everybody else is net long dollars. China itself has increased. I believe off the top of my head, it was roughly about 5% year over year. It's increase in borrowing in dollars. That's just through FX swaps. So again, if you're to look at this, all of these things are saying these people need dollars. They want dollars. And even if you're, China's had a terrible time normalizing its currency. There's been rapid swings in the renminbi. And so I think, kind of the way that a lot of people hedge against that is through holding dollars. I just came from Turkey, visiting family there. And the first asset that people hold is dollars, the second gold. Obviously, dollars are kind of cheaper to get access to than gold. But, a lot of people in these countries that everybody is making a fuss about, if you talk to people on the ground, they will take dollars gladly. If you get in a taxi, give somebody $1, they are more than willing to take it. So there's kind of this whole, more or less, if you will, black market dollar or dollar black market in a lot of these countries, where essentially you can just transact in dollars, kind of off the books of kind of normal settlement of currencies. And in Turkey, it's very well known. There's actually on Bloomberg a Turkish lira or dollar lira bazaar rate, which is bazaar just means market rate. So
there's it's like a black market. So it's kind of like Argentina and the exchange houses. So the government has an official exchange rate of the Argentinian peso versus the US dollar. And then there's the actual boots on the ground, the real exchange rate in Argentina of the peso versus the dollar, not the official government exchange rate. And this is because, all these governments are corrupt, all these central banks are corrupt, but in a lot of these countries, they're even worse with currency debasement and corruption.
Yeah, exactly. And again, I know I don't want to take this down the Bitcoin route, but if you actually look at people who live in very authoritarian regimes, none of them, transact in Bitcoin. If you remember the Hong Kong riots, everybody was transacting in cash, or even I believe at one point they were transacting in like these weird subway tokens, because that's the only way for you to be able to do things off grid without the government and a lot of these authoritarian countries following you. And so for a lot of people in very kind of, who live in autocracies, a lot of the only way for them to do that is transact in currency, and a lot of that is dollar denominated, just because of the the accessibility of dollars globally, right? So I'm not saying that that's necessarily good. I'm just saying that's how a lot of people get around the eyes of governments that watch a lot of people in these regions. And so, that's something that people also have to be aware of, right? Like if you've never kind of gone to a country that might have a very strict government, a lot of people don't realize that, but that is how they transact, because, if you're swiping your card, government can track you. So for a lot of these people, it's the kind of safest alternative.
Well, things are so bad in China with all the closed circuit television, social credit score. They have everything digital now, that if you want to pay cash in mainland China, you have to swipe on your smartphone a QR code first, telling the government and the banking system with WeChat Pay or Alipay that you're going to pay cash first. So it basically defeats the entire purpose of paying with cash, because you have to take out your QR code saying you're going to pay cash, alerting the government, the central bank, the financial system you're paying cash, and where you're paying with cash.
Yep. Yeah, exactly. And it's even worse in a place, if you were to look at China, like China, where you essentially have a, not just that, but then you have capital controls as well. And I was actually looking at some things that were happening. That was in the beginning of kind of summer of 2020, when China was trying to restrict credit supply to developers and investors, and try to decrease the quantity of loans given to the sector. The shadow bank in China actually came in, and these Chinese banks can somewhat hide some of their lending activities to keep them out of the kind of the eyes of the regulators. And that's
So these Chinese state enterprise banks, they are doing a lot of these FX swaps and forwards. Kyle Bass has talked about this for years. There's articles on this, I think, on Seeking Alpha. You can go and look these up. I think starting in 2015, 2016, when the Chinese banking system first started to falter, that they had enormous demand for dollars, and there was banking system problems. One of the main reasons is because of a lot of these. Not only are a lot of the loans in dollar-denominated debt, a lot of these Chinese real estate developers also borrowed in dollars, and now they're having lots of problems too. So there's a lack of dollars, and these Chinese banks are doing a lot of these games that you described earlier in the trying to pull demand forward, making sure they get access to dollars because there's a big dollar shortage in China.
Yep, exactly, and it's worse for the smaller kind of banks in China, but that's what a lot of these guys were doing. Again, I think it was. I think it was a report by Goldman Sachs, but they were essentially highlighting these kind of, and I believe it was Goldman Sachs. Don't quote me on that. It might have been another research, like another bank. But essentially, they were highlighting this is because all of these banks in China have been kind of their balance sheet were constrained by liquidity requirements. A lot of them actually went and kind of started to participate in all of this kind of shadow banking and offshore stuff to kind of get access to liquidity, just because they didn't have the ability to do that otherwise, right? Because the Chinese government regulates so harshly, the ability for access to capital. And so, that's had to turn a lot of these people to alternative sources of funding.
There's also a lot of accounting fraud and other shenanigans inside the Chinese banking system. There's a book out called China's Great Wall of Debt. I've interviewed the author, Denny McMahon. He's Australian and he speaks Mandarin. So he lived in China for many years and he wrote the book. He had to leave China, I believe, before he wrote the book. So the book's excellent. It's available on Audible audiobook. It talks about the shadow banking system. He interviewed people who were using collateral for the pawn shop loans in the shadow banking system. He interviewed corrupt government officials about local government financing vehicles. There's a ton of bad loans and dollar-denominated debt problems inside the Chinese economy and their banking system. And with real estate prices crashing in China, their tech bubble getting wrecked, currency devaluations, it's only getting worse for the Chinese banking system.
Yeah, and there's I think even if you look at China, obviously, I know we talked about this as well, but another one that I've been looking at is the Saudis, right? And I think that interesting things are happening on that front as well. And I do think that you could see, I'm not saying it will happen, it depends on how the Central Bank of Saudi Arabia kind of responds, but I do think that there is a potential for the Saudi Riyal to actually weaken because they're draining FX reserves. And so before they relied on oil, obviously, to kind of pay into the coffers of FX reserves. Now the problem is oil prices are down significantly. Granted, they do have an extremely low cost of production, and they made a lot of money over the last year and a half, 2 years. But now that things have kind of eased, you are seeing this rapid draining of their FX reserves. You're seeing depleted exports. I believe exports are still relatively high. I think they're like 112 billion Saudi riyals. But imports are now rising. They're up to about 61 billion riyals.
And so are the Saudis holding a lot of Chinese yuan. So I know everyone's talking about like the petro yuan and how China is making Russia and Saudis take Chinese yuan for oil, natural gas, petrochemicals, fertilizers, things like that if they're building a pipeline. Are these so Russia and Saudi Arabia, are they actually holding a lot of Chinese yuan and buying Chinese government debt with any of their oil profits?
No. Most of it's all mostly U.S. and euro denominated. Obviously, so what you see, and I found this so funny because if you remember on Twitter, when the PBOC swap lines hit like a new record, everybody was like, "Oh, look, China's swap lines are blowing out." But I don't think people actually understand what this means. Is sure, a lot of people are settling in yuan, right? More than they have been, let's say, over the last 3 or 4 years, right? The thing is, like, if you're Saudi Arabia or Russia, you're like, what the hell am I going to do with these yuan, right? Like, there's nothing that I can do with this, except buy like Chinese goods, right? But that's not really what they want.
You could also buy Chinese debt. So you could buy Chinese goods or Chinese debt. But yeah, you can't. I mean, I don't think the Chinese government's allowing them to go and buy physical gold tonnage from the Shanghai Gold Exchange and then export that gold to Russia or Saudi Arabia. The Chinese government's not allowing that.
Of course. And so what are they doing? They're saying, okay, well, now we have these yuan. Okay, PBOC, we want dollars back, right? And this is why these swap lines are increasing. So no, a lot of these people, they don't have them. And again, that's also something that I've said, like there's an opportunity cost to holding any currency besides the US dollar, because this kind of goes into the euro dollar system, right? Like if you hold, just to keep things simplistic, if you go from United States to France, for example, and it can be any bank, but outside of the US, but and you go and you deposit $1,000 US, they can then take that liability and create a loan against it, right? So it's actually beneficial. So like there's no opportunity cost to holding those reserves on your balance sheet, right? It's not like, okay, you give money to Deutsche and now they're like, oh, we gotta, give this to the ECB for them to, swap this back for euros from the Fed. No, like they can actually go and create loans against this. It can be used to fund long-term portfolios. They can use it to issue, dollar-denominated debt. There's a lot of things like within this euro-dollar system that they can actually do. None of that exists with any currency really besides the dollar, right? So, again, like if you're any of these nations, there's an opportunity cost to holding yuan, and that's essentially you're holding something on your balance sheet, as we said, that you can't do anything else with besides buy Chinese good or Chinese debt. Nobody,
if you hold also for our listeners out there, if you hold Chinese yuan and you hold Chinese debt, you're also trusting the Chinese government, their central bank, to not devalue their currency and not play games and not do crazy bank bailouts. So, I mean, a lot of people don't fully trust the Chinese government. So a lot of governments will do trade with the Chinese government, but I mean, holding their debt long-term, holding their currency long-term is another story, because they haven't allowed their currency to appreciate. Their currency has been devalued instead while they were industrializing, which kind of goes against normally, if you're taught like the history of currencies, when an economy is industrializing, right, doesn't the currency normally appreciate? And that hasn't happened in China.
China. Yeah, exactly. And, this is actually brings up two more important points. Is China's soft peg, the renminbi soft peg to a basket of currencies. The Gulf, or the majority of the Gulf states, are hard pegged, right? So one, when you actually start to drain FX reserves, like in the case of Saudi Arabia, what's happening? You're actually putting your currency at risk, right? Of the peg breaking, because investors are getting worried that there's not enough FX reserves to hold the peg, or the fact that if any debt, for example, like in Turkey, they've issued euro bonds, and they've started to drain their euro denominated debt, that there's not enough euro denominated FX reserves to cover the short term debt issuance. So investors start to get worried, and what happens? You then have capital flight, right? People pull their money, and it's been very drastic in the case of Turkey. So that's one issue that faces Saudi Arabia, but the same thing is that faces China as well, right? Like if China starts to drain FX reserves, they then run the risk of devaluation of currency, and kind of losing control of that peg that they've tried to maintain, the soft peg. or you get massive continual capital outflows. And like I said, that's already been a big issue for Chinese debt markets. So, a lot of these nations really have to thread the needle on the way that they're conducting monetary policy. And I think that if you actually look at a lot of them, they're kind of in the loose cannon phase. I mean, the U.S. is loose cannon, but compared to some of these nations, we're like the cleanest dirty shirt.
Yeah, I don't trust any of these governments or fiat currencies at this point, but I guess it's different degrees of abuse and corruption and mismanagement of their of inside their economy. I mean, there's a ton of Chinese companies, as bad as accounting fraud is here in the United States, and there's pretty bad examples of this with a lot of the stuff with the share buybacks with debt and all the crazy shenanigans going on. A lot of these Chinese state-owned enterprises, there's just tons and tons of red flags that you're not going to read about in Seeking Alpha articles talking about how good, how cheap Alibaba stock or these other Chinese state-owned enterprises are. I mean, there's a lot of red flags with a lot of stuff hidden in the footnotes.
Footnotes, yeah, exactly. And so I think that that's what people have to be really careful about when they start to, I hear a lot of people saying, oh, I want to, move allocation to X, Y, and Z country. But you also have to remember that there's massive potential risk there that's just not faced in the United States, more or less. And so that's something that always has to be kept in the back of the minds of people when they're kind of considering this whole de-dollarization argument, because it's one that's extremely important. Sorry.
So for cross-border trade settlement, do you see a scenario where the amount of dollar usage for cross-border trade settlement will rapidly decline, or do you think that's also going to be difficult?
I also think that that's going to be difficult. In my Substack, I was looking at overall turnover volumes, and so what we're actually seeing is the dollar one is the most utilized currency by a substantial margin, and you've seen continued growth in the utilization of the dollar. BRICS is at the bottom, and it's pretty much stagnated. I mean, the growth again, or the growth, sorry, is coming off a very low base, but compared to the U.S., it's nowhere near. So right now, the dollar continues to kind of be the kind of the main driving force behind all of this. And even if you were to look,
I think a good way to think about this, because we're not on a gold standard since Nixon closed the gold window. We've all been on fiat currencies. We're on a dollar standard, so I think we're on a global dollar standard. As kind of the best way to think about things. And the dollar is used, whether that's like boots on the ground or central banking level. A lot of people, it's considered, whether you're in another country or not, it's considered the best for cross-border trade settlements or boots on the ground. If you're a taxi cab driver, a lot of them will take dollars.
Dollars, exactly. And there's a reason that it's very important for kind of cross-border as well as bilateral trade settlement. And again, it's a bit this could be a topic in and of itself, but it's essentially dollar invoicing. And I'll just kind of give, like, the IMF essentially says that it essentially, what invoicing shows is it postulates a dominant currency paradigm whereby export prices are instead set in the so-called vehicle currency, which in today's world happens to be the US dollar. And there's actually something very significant about this. I posted a chart in that Substack as well, where if you were to look at the dollar share of exports that are invoiced in US dollars, is larger than the share of exports that arrive at the shores of the US. And so that gap actually tells us something extremely significant. The gap between, exports invoiced versus exports destined for the US. And that's that, the role the dollar has in global exports. And, essentially what we see is that the dollar's role in global trade is more than just the petrodollar, which a lot of people talk about, or commodities. And actually, once you deduce out exports from invoicing and export shares, the dollar share of invoicing, is 23%, and that exceeds the gap share of exports destined for the U.S., which is 10%. So there's this kind of massive, reliance on the dollar, not just because those things are arriving in the U.S., but just because of overall the stability that it brings, to kind of being the denominator of, as I said in the beginning, kind of being the denominator of where export prices are set, and that vehicle currency being the US dollar.
Yeah, I think it has a larger share of cross-border trade settlement than reserve asset. I think it's used for a lot of different countries. So whether it's Sweden and Japan, or emerging market countries and a country in Europe. So a lot of that trade gets settled in dollars for our listeners out there in very basic terms. So even though you're two countries that have nothing to do with a U.S. company, a lot of this trade is still settled in dollars.
Mm-hmm. Yeah, and invoiced as well, right? So that's always something that's going to be significant. And then, for anybody who's interested in that, there's a paper called by the IMF, which essentially highlights this. I believe it's called dollar invoicing and bilateral trade stability or something like that. But then you get into, foreign exchange, kind of, and how it affects foreign exchange rates, how it affects FX pass through, all of those kinds of things. So that's a really good paper that kind of highlights the significance of the U.S. dollar, and how that stability and the fact that the U.S. dollar doesn't have a lot of volatility actually leads to more stable trade. Because if you have massive fluctuations in that denominator of the kind of the vehicle currency, it affects, one, the price of exports, and two, overall trade volumes. So if you're having a lot of volatility, obviously you go between like inflation and deflation, and obviously that changes, kind of, it passes through to what Keynes called menu costs, right, where you're constantly, if you're a manufacturer, having to change prices because there's a massive fluctuation in the denominator of that currency, which obviously hampers global trade and exports. So that's something significant as well, just from an actual overall global bilateral trade standpoint.
There's also a white paper that came out in the last couple of months on the on the Bank of International Settlements website. It's called the Dollar-Based Financial System Through the Window of the FX Swaps Market. I know you haven't read it yet. It's by Young Song Shin from the Economic Advisor, Head of Research, Bank for International Settlements. And he goes through in more details a lot of the stuff you discussed about how a lot of the banks in China and other countries use these FX swaps and forwards, and they get demand for dollars. They need dollars. So even though the narrative out there is de-dollarization, rapid de-dollarization, you see Luke Gromen, Peter Schiff on TV, on Tucker Carlson, well before the Fox News got rid of him. Luke Gromen was on there, but they're doing the rounds on business television talking about de-dollarization. I mean, Luke has been talking about this for over a decade, and Peter Schiff's been talking about this for 15 or 20 years. And yet we haven't seen a rapid trend where dollar usage has declined. Every time the dollar gets weak again, it just borrows more. The foreign governments and foreign corporations borrow more in dollar-denominated debt. So while they say stuff publicly, they're not able to actually change the system drastically, at least not yet. Maybe we'll see changes in the future. But I think in the short term, to your point, I don't think we're going to see any major changes to the current system.
No, I would agree with you there. And again, I mean, I would just, preface it by saying as well, is if that was to come to fruition, I don't think that that's a world really anybody wants to live in, right? That would be a very bad scenario.
Well, honestly, I'd prefer to get rid of debt-based fiat currencies and fractional reserve banking and go back to more gold or silver-based trade settlement, because I think that actually worked for a while, but the government, I don't get a vote. The average person on Main Street doesn't get any of these votes. It's governments and central banks. It's the people at the very top, the economic and political elites, that decide all this stuff.
Yeah, exactly. And I mean, like, yeah, again, that's something that could, be a topic in and of itself. But then the problem becomes, how do you deal with the kind of the whole the growth aspect of that, right? Where the elasticity of money is much more inelastic. I think that in and of itself is an interesting concept because if I believe if you were to look, up until believe it's the 1900s, global world GDP, I think, grew at about 2.5%. And a big function of that was, the fact that we didn't really have, until the Industrial Revolution, rapid GDP growth. Everything was kind of just stagnant. That kind of, was the Malthusian, form of economics where everything's consumed in the current period, and if you produce more and population increases, there won't be enough food, there'll be famine, etc. And so the economy is just kind of constantly in this steady state. And after that we had this rapid rate of growth. Yeah, and then the question is,
but I think the problem now is we have debt-based growth. So we have fractional reserve banking, the banking system, whether it's the large European banks, Chinese banks, U.S. banks, Japanese banks, Canadian banks, Australian banks. They all have immense problems right now with bad loans and stuff like that. The problem is credit growth, debt growth. It's this debt-fueled model. Debt-based fiat currencies, fractional reserve banking, the derivatives market. I mean, the size of the euro dollar market, it started in the 1950s from tens of billions that were created by European banks for offshore dollar lending. And here we are, 5 or 6 decades later, and it's many trillions of dollars in size. I think it's over 15 trillion for the euro dollar market. And that means that size of the euro dollar market, that's demand for dollars. So
yeah. Yeah, no, I would agree with you, and that in and of itself is a massive issue. And I think this is, and I mean he's much more intelligent than I, but this is also what makes me laugh about people like Ray Dalio, is because on the one hand he's like U.S. has a debt problem, on the other hand he likes China, and it's like, well, China's debt.
If you read his book, sorry to interrupt you about Dalio. If you read his book Principle, he admits he got insider access deals in China, and that comes at a very steep price. That means basically he's going to be marketing for the Chinese economy for the rest of his life. So in exchange for making many millions of dollars on those insider access China deals for Chinese stocks, Chinese companies that he got over the years, he's not going to be able to criticize them publicly for the rest of his life. He's going to have to market for them.
Yeah, but again, I mean, the Chinese debt situation is much, much worse than that of the United States. I believe, if I remember correctly, because I did a post on this, it was about a year ago, so it's probably gotten worse. But in the U.S., it was $1.40 of debt to generate $1 of GDP. In mainland China, I believe that was like $2.50, so $2.50 of debt to generate $1 of GDP. And in Hong Kong, it was by far the worst. It was about $4.50 of debt to generate $1 of GDP. So, everybody talks
and that
about,
assumes that their GDP, I mean, I've seen videos out there going through the data saying that 60% of their GDP, there was a video out in the last month or two from a large economics channel going through all the data. He put it out. I posted it in the Wall Street for Main Street Facebook group. I'll see if I can find it and put it below this interview in the information and description section. He laid out the case that 60% of China's GDP is fake, and then there's trillions of bad debt that was borrowed from these local government finance vehicles, which are like shell companies. These are local governments where the politician in charge wanted a promotion, so they set up a dummy company and borrowed a bunch of money from the banks. Wink, wink, nod, nod. They can't pay back those loans. So there's a lot of problems with local government finance vehicles, and then also China's shadow banking system. And there's a lot of dollar-denominated debt inside the Chinese economy. So the narrative is China doesn't need the dollar anymore, but inside their economy, they borrowed a lot of dollar-denominated debt.
Yeah. No, I have nothing to add there. You hit it spot on. I would 100% agree with you. So, I think that this is a lot of things that people have to think about, but obviously that's not really the bandwagon at the moment. The bandwagon is the end of the U.S. hegemony. So,
it's a bit, as we've been discussing here, and there's a lot of complicated terms, and I'll try to put some some links to information to some of these articles in the information description section below the video. It's more complicated. The de-dollarization process is extremely complicated. It's not just the petrodollar, it's the derivatives market, it's euro dollar, it's cross-border trade settlement, and the dollar-denominated debt. Every time the dollar gets weaker, so if the Fed cuts interest rates again, goes back to zero interest rate policy, expands their balance sheet, most likely these foreign governments and foreign corporations, they're probably going to borrow more dollars if the dollar gets weaker.
Yeah, they will. They will. And I think that that's going to baffle everybody's mind. And then we'll be on to the next, the next thing at that moment, which will, it seems like every couple of weeks something new pops up, right? So it seems like now this week the headlines, OPEC is going to crash the world with higher oil prices. So, the narrative's constantly changing.
Well, I think the major problem is the interest rates the Fed has set. So, I mean, the Fed took with all the monetary currency and credit that was created the last 2.5 years, they took the car up to over 120 miles an hour, 140 miles an hour. And then with the interest rate raises, they just slammed on the brakes. Anyone who's driven that fast and then slams on the brakes knows that bad things are going to happen.
Yeah, I 100% agree with you.
So I really enjoyed our discussion today. We'll have to have you back on in the future to talk about de-dollarization, the Chinese economy, how things work with the global financial system. If my listeners want to check out your work on Twitter or your Substack, how did they do so?
Yeah, so my Twitter is just at Deerpoint Macro, and as well as my Substack is exactly the same. So Substack, I believe, at Deerpoint Macro, or if you just type in Deerpoint Macro, it's up there on Google. I don't remember the entire URL for it because I just started again writing on my Substack. I was off it for about 8 months, but those are kind of the two best channels. And then, I'm always happy as well to connect with people who are willing to do so on LinkedIn to kind of lift a bit of the veil of anonymity. But it's just either way, people can connect to me, but usually Twitter's the best.
And are there any beginners articles? So if my listeners want to start reading about like what the foreign banks are doing with dollar forwards or FX swaps or forwards, are there any basic articles? I know Kyle Bass, this was like 2 years ago, and I know I'm going to get people commenting, you have to find the link to the tweet. How dare you bring this up and not post the URL? But he was posting this in article links a couple years ago. I know there's a Seeking Alpha article. I'm not sure if I could find it, but people can look up that the Chinese banks were getting heavily involved in this stuff. I think at one point they were doing over $100 billion a day of this stuff with the dollar, the forwards and the swaps.
Forwards and the swaps, yeah. Clarus, which is CLARUS. I believe they only tracked like from their website, if I remember correctly, they only track like interest rate derivative swaps and kind of markets in general. But it's all kind of the flows of, offshore and onshore banking. And so they have a lot of good information there that people have access to, as well as I don't work for them. I know that they do have a paid kind of thing as well, where you can actually get access to all their data. So all the bilateral settlements, all the clearing of markets for, all the different currencies. They do a lot of that kind of stuff. But their blogs and everything on swaps and all of that, that's absolutely free. So yeah, and the BIS as well, the Bureau of International Settlement. They have a lot of stuff on the FX swaps as well.
Yeah, I discussed the white papers of the Bank of International Settlement. So there was the white paper from March. And again, that one is called the Dollar-Based Financial System Through the Window of the FX Swaps Market. So that goes into more detail. But there's if you go back over the last 4 or 5 years, there's other white papers talking about this. All you have to look up is dollar-denominated debt. And a lot of these white papers and articles will come up talking about it.
Yeah. Yep. Oh, yeah. Sorry. I think I said the Bureau. Yeah. The Bank of International Settlements. Yeah. So those two are good. Bank of International Settlements and Clarus, I would say, are probably the two best two.